BKV Corporation decisively beat consensus this quarter.
Yeah, they really did. Adjusted EPS came in at 18.46 cents, which completely crushed the 25-cent estimate. I mean, that's a beat of 21 cents right there.
Right, and revenue just surged, right? I'm looking at $465.54 million.
Exactly. It blew past the expectations of $355.25 million. So that marks a 44.6% year-over-year increase.
Wow. And looking ahead, they updated their guidance, too. They raised their full-year 2026 net production midpoint up to 950 million cubic feet equivalent per day.
Yeah, and the market reacted immediately. I mean, the stock gained 4.4% the day following the report, closed at $24, and then it just kind of drifted higher to close the week around $24.46.
So that's a total post-earnings jump of over 6%.
It's a solid rally.
So for you listening right now, you've seen that headline pop.
Mm-hmm.
But we need to unpack the segment performance, the margin shifts, management's capital allocation, and honestly, the real risks hiding in the balance sheet to see if this rally actually has legs.
Yeah, because to understand how BKV generated that massive top-line beat, we have to look straight at the cash engine of the business, which is the upstream segment.
The natural gas production.
Exactly. Net production exceeded their guidance, hitting 978.3 million cubic feet equivalent per day.
That's huge.
It is, but volume is just one part. The margins are what really matter. Upstream adjusted EBITDAX hit $127.8 million. Total operating cash costs were highly efficient, coming in at just $1.39 per thousand cubic feet equivalent.
And their realized natural gas prices, that includes derivatives, right?
Yeah, including derivatives, those held steady at $2.60 per thousand cubic feet.
Okay, wait, I have to push back here because looking at the GAAP numbers, there's a glaring contradiction. GAAP net income actually dropped year over year. I mean, it went from $107.8 million down to $75.8 million. How is the market treating this as a massive beat when net income dropped?
Right. Well, that gap drop is largely just noise from unrealized derivative losses.
Okay, paper losses.
Exactly. Mark-to-market accounting rules force them to record the fluctuating paper value of their hedges. So for the listener, focus on the adjusted net income. That actually jumped 110% year over year.
Wait, really? 110%?
Yeah, it went up to $50.7 million. That's the real operational cash flow.
Okay, let's unpack this. It's like, well, think of their recent drilling success in the Upper Barnett as finding a hidden gear in a really reliable engine. They've significantly de-risked about 50% of those locations.
Yeah, the efficiency gains there are incredible.
Right, and they dropped break-even costs from $3.75 all the way down to $3.25 per MMBtu.
Which is massive when spot prices are depressed. And, the cash generated from that highly efficient upstream engine is exactly what's funding BKV's next major strategic pivot, right? The power segment.
We've had a surprisingly mixed quarter, if we're being honest.
Totally. Operationally, it was a success. Temple IN2 generated 2,222 gigawatt hours. That's a 16% increase year over year.
With zero forced outages, right?
Yeah.
During a period of really strong ECOT demand in Texas.
Zero. The plants ran perfectly. But the financial drag is the issue. The segment actually posted a net loss of $6.8 million.
Okay, here's where it gets really interesting. They generate 16% more power in a Texas grid starving for electricity, yet they lose money on it. Why?
It's all about their vulnerability to spot pricing on the wholesale market. The wholesale power prices just dropped to $41.59 per megawatt hour.
Oh, wow. Because of the renewables flooding the grid during the day.
Exactly. Wind and solar crashed the daytime price, so that squeezed their spread, basically their gross margin down to just $22.31.
So they were moving volume, but the margin was just too thin to cover the heavy fixed costs and debt of the facilities.
Right. And this perfectly explains management's aggressive push for long-term power purchase agreements, or PPAs. They want to get off the volatile spot market.
They need guaranteed contracted revenue.
Yep. And their future pipeline shows they're serious. They secured 1,100 acres near Temple. They got Phase 1 air permits, and they're advancing that massive 6,200-acre North Texas energy complex.
Pushing their operating capacity toward 3 gigawatts.
Exactly. 3 gigawatts.
But if you are dramatically expanding your natural gas power generation like that, you are inherently expanding your emissions footprint.
Oh, absolutely.
Which brings us to how BKV is solving that problem in-house with their carbon capture segment, the CCUS division.
Yeah, and Q2 was huge for them on that front. Commercial operations commenced at the Cotton Cove and Eagle Ford projects.
Those are active now.
They are. Combined, they're expected to sequester 120,000 metric tons of CO2 annually, and their total quarterly sequestration across the board had about 35,900 metric tons.
That's serious volume. And Barnett Zero has now buried, what, 375,800 tons since 2023?
Yep, 375,800.
See, I want to emphasize to the listener why this matters for a retail stock. BKV isn't just an E&P company pumping gas anymore. They operate a closed-loop model.
Right, exactly.
They extract the gas, they burn it for grid power, and then they capture and bury the resulting carbon themselves.
What's fascinating here is how this closed-loop model basically acts as a commercial moat.
How so?
Well, it perfectly positions them to sign those lucrative PPAs we were just talking about. ESG-conscious utilities and, massive data centers, they require clean, firm 2047 power.
And wind and solar just can't provide that baseload reliability without insane battery costs.
Exactly. BKV steps in and says, we'll give you firm natural gas power, and we'll bury the carbon so you meet your zero-emission mandates.
It's a silver bullet for tech companies. But building 3 gigawatts of power capacity and multiple carbon capture facilities is highly, highly capital intensive.
It is not cheap.
Right. So let's look at the balance sheet to see if they can actually afford this integrated strategy.
Well, looking at the debt profile, they have $1.3 billion in total debt. And it's heavily weighted. About $618 million of that is sitting in the power segment.
Which explains that interest expense dragging the power segment into a loss.
Exactly. But they do have a solid liquidity safety net right now. Total liquidity sits at $836.7 million.
Okay, so how is that broken down?
That's $152.2 million in cash and another $684.5 million available on the reserve-based lending facility. Plus, their net leverage ratio is a very manageable 1.78x.
Keeping leverage under 2x during a massive infrastructure build-out is impressive. But what about the spending going forward?
Yeah, so their heavy 2026 CapEx guidance is set between $690 and $875 million total. And a massive chunk of that $475 million is dedicated solely to power strategic capital and investments.
So what does this all mean for the retail investor listening, trying to figure out the risk here? Because you can't forget, BKV missed earnings estimates sequentially in Q4 2025 and Q1 2026.
Yeah, they were under a lot of pressure.
Right, so this Q2 beat was basically a desperate prove-it moment to show the upstream engine could fund this grand vision.
And management knows that. CFO David Tameron specifically talked about maintaining disciplined capital allocation and keeping investments milestone-driven.
Meaning they don't want to burn cash on turbines until the PPAs are actually signed.
Exactly. The primary risk factor here is execution timing. They are burning heavy CapEx now to build generation capacity.
And if they fail to secure those long-term PPAs,
then that $1.3 billion debt load becomes highly restrictive, especially if natural gas prices dip and the upstream cash flow shrinks. They'd be totally exposed to the spot market again.
It is an incredible high-wire act. The upstream engine has to keep humming to fund the power build-out until the PPAs arrive to stabilize everything.
Yeah, that's exactly the dynamic.
I want to leave you with a forward-looking scenario, something that wasn't covered in the report but feels like the logical endpoint here. As tech giants desperately hunt for massive, reliable 247 power for their AI data centers, they need gigawatts of clean energy.
Right. The AI boom is power hungry.
Exactly. So could BKV's fully integrated closed-loop model gas to power to carbon capture make them the ultimate acquisition target? I mean, for a big tech company looking to literally buy its own clean energy grid.
Oh, that's an interesting thought.
It's something to watch closely as this 3-gigawatt pipeline develops. Make sure you hit follow on the show so you never miss our daily, no-nonsense earnings coverage.